If you're looking to become a homeowner in 2025, then this video is for you. Today I'm breaking down everything that you need to know about qualifying for a conventional loan. We're going to discuss everything from credit score requirements to down payment requirements, what it takes with income and employment, so that you know exactly where you stand as you start to plan to buy that home in 2025. But let's start with the big question. What is a conventional loan? Simply put, it's a loan that's not insured by the federal government like FHA and VA, but instead it's backed by private lenders and typically follows the guidelines of Fannie Mae and Freddie Mac. So why does this matter to you? Well, it ultimately doesn't matter. But what I will say is that conventional loans typically offer the best financing terms when you're putting a little bit more money down. So what are the basic eligibility requirements when it comes to using a conventional loan? It's really no different than any other loan. It really starts with having a good job history, having good income history, along with having a manageable debt load. But with that, I want to go a little bit further here and talk about income and talk about employment. If you're someone who currently doesn't have a job at all, or if you've been hopping from career to career and you really haven't been stable at all, it's going to be very, very difficult to get financing, regardless of whether you're using conventional or FHA or any other loan program out there. You really need to have a history, a 2-year history of both stable income and employment, which means essentially you've been in the same line of work for the last 2 years. Now with that, one of the questions that comes up is, well, I've changed jobs. Changing jobs is okay. You just want to be doing something similar. If you've been in sales, you'll want to be in sales. If you've been in management, you want to kind of be in management. Now, there are a couple nuances here where you can have some variances in these things, but more so than anything, you just want to have a history of being employed for the last 2 years. Now, with that, there can be some changes like I mentioned, but what you don't want to see is going from like a wage earner job where you're getting a paycheck every 2 weeks or once a month or whatever the schedule is to being self-employed where now you're a business owner or maybe you're driving for Uber and that's your only income. Because the problem with that is there's not a history of it. But on the flip side, if you've been self-employed for the last 2 years and now you've flipped and you've become a wage earner and now you're working for someone, as long as you have a history going up until that point, you're probably going to be okay. But on the flip side, if you're someone that really hasn't had a job at all and you just got your first one and now you're trying to buy a house, it's going to be very, very difficult. But you should still pay attention to this video to understand the basics of what you need to know so that when the time is right, you can set yourself up for success. Now, the second part of that equation is the income piece. Now, keep in mind, there's no maximum income that you can make. You can make as much money as you want, and there's no minimum income piece. You can also make as little as you want, assuming you meet the debt to income requirements, which we're going to talk about here in just a minute. But when it comes to income, you have to have a history of that income. That doesn't mean your income can't change, but essentially you don't want big changes in your income. You want consistent. So if your income is consistently going up every year, that's okay. But if you're going from $50,000 a year to $150,000 a year, back down to $75,000, then to $200,000, that's a problem. And better yet, can create issues when it comes to qualifying for a home. So the first piece of the puzzle is having that stable income and employment, which is going to take me into the second requirement that you need to have when using a conventional loan, and that's a minimum credit score of 620. But with that said, I want to be very, very clear here. Just because you have a 620 credit score doesn't mean you're going to qualify for a conventional loan, even though the guidelines allow it. And that's because a lot of lenders out there have something called an overlay on their program where they require higher credit scores. Even though Fannie and Freddie say 620, they might want a 640 or a 660. So if you're at the bottom end of those credit scores, if your credit score is around 620 or 630, my recommendation to you is to work on your credit before buying a home. And the reason for that is you're going to get way more favorable terms, a better interest rate, which is ultimately going to translate into a lower mortgage payment. So if you can focus on improving your credit score, even though you might meet the guidelines and be able to buy a house, my recommendation is to still maybe hold off on buying the house and work on that credit score, because having that better credit score is going to be a way better situation all the way around. But with that, understand that credit scores can be as high as 850, and the higher your credit score is, the more favorable terms you're going to get, not only with conventional loans, but typically with most finance. So I would actually challenge you to come in with a higher credit score if possible, so that ultimately you get a way more favorable loan. But we've talked about income and employment. We've talked about credit score. Now let's talk about down payment. One of the nice things about conventional loans is that they allow you to buy with as little as a 3% down payment. But here's what I'll say. If you only have a 3% down payment, chances are FHA is going to have way more favorable terms when it comes to financing than conventional loan. Now, yes, there are a couple of negatives when it comes to FHA and how they do upfront mortgage insurance, but I would ask you to also look at FHA as an option if you're only putting 3% down. Chances are it's going to have a lower monthly payment overall. So just make sure your lender is giving you a side-by-side comparison if you're going through this process. Now understand, this video is not about FHA, but I want to be very, very clear. It could end up being a better option for you. But as I mentioned earlier, the more money you put down on a conventional loan, the more favorable terms you're going to get, the better the interest rate is going to be, which in turn is likely going to translate into a lower monthly mortgage payment and also allow you to qualify for more home. But there is a myth out there that you have to put at least 20% down using a conventional loan, and that's simply not true. You can get away with as little as 3%, and you can put as much money down as you want. You can put 50, 60, 70% down and buy a home using a conventional loan. So while there is a minimum, there's no maximum amount that you can put down. But something to remember here, anytime that you put less than 20% down and you buy a home using a conventional loan, you're going to have mortgage insurance, PMI. It's private mortgage insurance, and it's required by the lender in order to protect themselves in case you default on your loan. It's not there to protect you. It's not insurance for you. It's insurance for the lender. Over time, they've realized that those that put less than 20% down are a higher risk. So essentially what they're doing is just protecting themselves in case you end up defaulting on that loan. Now understand, once you get 20% equity in that property, either by paying down the principal balance and or gaining enough appreciation in that home where you have 20% equity in that property, you can have that mortgage insurance removed, which is one of the huge pluses of conventional loans. Now with that, sometimes you can just call and have the lender remove that mortgage insurance because they see that the equity is there. And in some cases, it might actually require you to get an appraisal on that property in order to have it removed. But understand, it's typically not going to happen. It's not going to be removed 1 month after buying your home. It's probably going to be required on that loan for at least 6 months, maybe a year, depending on the lender. So even if you gain that equity in that period of time, chances are you're going to have mortgage insurance on that loan for at least the first 12 months. Now you all know who Dave Ramsey is. Dave Ramsey believes that you shouldn't be buying a house unless you have at least 20% down. And I simply could not disagree more. But I want to ask your opinion. Do you think you should be buying a home if you have less than 20% down? Do me a favor and let me know in the comments below. Now, on top of that requirement, Dave Ramsey has some other crazy requirements as well, like you should only be doing a 15-year fixed, which is something else I also disagree with, but that's not why we're here. We're here to talk about conventional loans. And the next thing I want to talk about is some of the changes for 2025, which is really the only change in 2025, if we're being honest. Conventional loans have been pretty stable over the last couple of years. Not really a lot of changes when it comes to their guidelines, but there is one thing they change every single year, and that's the loan limits. Almost every single year, as the median home price grows in the United States, they up the loan limits to essentially allow more people to qualify under conventional guidelines than the previous year. And with that, they've actually taken the loan limit to $806,500 for a 1-unit property. A 2-unit property, 3-unit, 4-unit, that's all going to be right here on the screen. But at the same time, if you're living in a high cost state like I am here in California, there are actually something called high loan limits under conventional guidelines, which allows you to finance just over $1.2 million on a 1-unit property. And you can see the 2, 3, and 4 units here. Well, a lot of people out there will say these rising loan limits just contribute to housing unaffordability, that by allowing more people to qualify, you're just making things more and more unaffordable. And I completely disagree. What this does is that it rather allows potential home buyers to increase their purchasing power by keeping up with rising prices. Because it doesn't ease the restrictions at all, it just ups the loan limits as homes become more and more expensive, which at the end of the day is a huge benefit to anyone using a conventional loan. But again, this is a question I have for you. Do you think the fact that they continue to raise these loan limits keeps making housing more unaffordable? It keeps making it more expensive? Do me a favor and let me know in the comments. Now, the next thing I want to talk about with conventional financing is debt to income ratio. Now, this is one of the things that's probably the most misunderstood across any loan platform, not just conventional loans. And it's misunderstood in the way that it's calculated and why they calculate it a certain way. But let's be very, very clear. Debt to income ratio is the amount of monthly debt you have versus the amount of monthly income that you make. So in order to calculate your debt to income ratio, the very first thing you have to do is be able to calculate your monthly income. And if you're a wage earner, it's really, really simple. You just start with your annual salary. What is your W-2 for the year? And typically what a lender is going to do is they're going to average your last 2 years of W-2. So they're going to take your 2024 W-2 and your 2023 and maybe even any pay stubs that you've received since then. They're going to add it all together and they're going to divide it by the number of months in there. Let's just say for very, very simple terms that you made $110,000 in 2024 and in 2023 you made $90,000. So combined that's a $200,000 income. Well, because we annualized it over 2 years, we're going to divide it by 24 because there's 24 months in 2 years. So that's going to break down to $8,333 per month. So now we figured out your income. Yes, we take your gross monthly income before any taxes come out. So that calculation that we just did, that $200,000 divided by 24, that's your gross monthly income. That's what we use. And the reason we use your gross monthly income is because that's what lenders look at. They look at it before any taxes come out. Even though you pay taxes, we know you pay taxes. We know you put money into a 401k. You might have some child support or some alimony or whatever coming out of your check. And that's important for you to know when you're creating your budget. But from a lending standpoint, the lender is going to use the gross monthly income. So now we have the gross. That's $8,333 per month. Now what we need to do is go figure out your debts. Where do we find your debts? They're going to report on your credit report. Now, for most people out there, they don't have a copy of their credit report to calculate their debts, but essentially what you're going to do is you're going to use the things that would show up on your credit report, things like your car payments, your credit cards, installment loans, student loans. All of those things are going to be calculated and factored in to your monthly debt. And something to keep in mind with that, they use the minimum monthly payment on credit cards. If you have student loans, they use the IBR payment most of the time. Now, there are a couple stipulations there we're not going to talk about in this video, but essentially you have all of the things that are computed on your credit report and they're factored in. Now, they're not looking at things like groceries or, what you spend in car maintenance or childcare, any of that stuff. That, again, should go into your budget. It's not factored into your debt to income ratio. So your debt to income ratio is simply your debts versus your income. Now, with that being said, there's a front end ratio and a back end ratio when it comes to your debt to income ratio. The front end ratio is your housing expenses, the proposed housing expenses from the property that you're trying to buy. So let's say, for example, your mortgage payment is $2,500 a month and you have $500 in taxes, insurance, everything on top of that. So $3,000 is the total housing expenses, the proposed housing expenses. Well, for a front end ratio, they take that $3,000, they divide it into the $8,333, which in the case of this would mean your front end ratio is 36%. Now, the back end ratio is a little bit different. It's your housing expenses, that $3,000 that we mentioned, plus any other debts that show up on your credit report, the credit card, the car payments, the student loans, all the things that we just talked about a minute ago. All of those payments are added on to that front end ratio and still divided by the gross monthly income. And in the case of conventional loans, you really want that back end ratio no more than about 45%. Now, there are cases where you can go as high as 50%, which means 50% includes your housing expenses plus all your monthly debts divided by your income can be 50% in some cases and still qualify for a conventional loan. But most of the time, the guidelines want you to stay under 45. Now, there's a lot of people out there that believe that you shouldn't spend more than 25 or 30% on your total expenses. Housing expenses, debts, all of those things in order to buy a home. Now, we're in a high cost area like California. Things are more expensive. It's very, very difficult to keep your total housing expenses and your debts and everything at 25% or 30%. So I believe you can go higher as long as you have a detailed budget. But I'd love to know what you think. What's the max that you think you should go when it comes to your debt to income ratio? Do me a favor and let me know in the comments. But I want to point out something when it comes to debt to income ratio. When you have compensating factors, the higher your credit score, the more money you're putting down, maybe the more money you have in the bank outside of what you're putting down. These are all things that will contribute, that will allow you to go to that higher debt to income ratio of say 49.99%. But if you're coming in and you have a super low credit score and you have a minimal down payment, you don't really have a lot in the bank, chances are you're not going to be able to push that ratio. So the lender is going to look at the overall profile of who you are when determining how much you can actually push it. But with that, I typically start these videos by talking about this being for novelty purposes only. You shouldn't use this video and determine whether or not you can qualify for a conventional loan. It's a really good basis. It's a good guide for you. But you should really have a conversation with a professional to make sure that you meet the guidelines. And what goes into that process is they're going to take a look at your credit score. They're going to want to see your pay stubs, your W-2s. They're going to want to run your credit. And this is completely normal because this is part of the pre-approval process. This is what you're going to need to do regardless of what lender you choose. But just make sure you're working with a professional. Don't go Google mortgage lender and then call the person that you see, because understand they have to pay for that advertising on Google. Go with someone that you can trust and can guide you through the process. Now, if you don't know where to start, my team and I have helped hundreds of people here off YouTube over the last couple of years, and we would love to help you. So if you'd like a free pre-approval, do me a favor and check that link in the description of this video. Now, regardless of what lender you go with, your lender should be giving you options when going through that process. They should show you what a conventional loan looks like, assuming you qualify, but they should also give you FHA options if you qualify for FHA. They should give you options and let you make the decision. Your lender should never be the one telling you what loan program you have to do. Rather, they should be giving you options and guiding you and letting you decide. And that's because there are times when FHA might actually end up being a better loan program. Understand that FHA has better rates than conventional all the time. In fact, government loans always have better interest rates than conventional loans. But that doesn't always mean that FHA is the right loan. Because of some of the upfront mortgage insurance requirements and other requirements, you need to be able to see both options side by side to determine which program is right for you. But let's take a minute here and talk about why conventional might actually be a better option. It doesn't have upfront mortgage insurance, like I mentioned earlier. FHA requires that. Conventional loans do not, which is a huge benefit. And on top of that, there's no monthly mortgage insurance when you're putting 20% down. FHA still has monthly mortgage insurance when you're putting 20% down. Conventional does not, which is another huge plus. In addition to that, one of the other things that we mentioned earlier is that mortgage insurance is really easy to get off once you have 20% equity, whereas with other loans, it can be a little bit more difficult. So at the end of the day, conventional loans can end up saving you a lot of money in the long run, but just make sure you're comparing both options so that you know exactly what you're getting into. Now, one thing I didn't mention earlier, because most people watching this video are probably buying their first home, but a conventional loan can be used to purchase your primary home. It can also be used to purchase a second home or an investment property. And you can use conventional financing as many times as you want. It's not a one and done type thing. In fact, it's probably the most popular loan program out there when it comes to financing. Now, the last thing I want to talk about is closing costs when it comes to conventional loans. People often ask, how much is it going to cost me in order to use a conventional loan? And the answer is not clear, unfortunately. It's going to depend on what state you're in. Some states are high closing cost states, which means in addition to your down payment, you're going to have closing costs, and they could be higher in some states than others. California is considered more of a lower cost state, and that's where I'm located. New York and some of these other states, closing costs can be quite a bit higher. But either way, you're going to need money for closing costs on top of your down payment unless you're getting a credit from either the seller or your lender or someone during the process. So it's not a loan where you can just put the down payment down in most cases and buy the house. It's going to require some additional on top of that. And that's why it's really, really important that you start the pre-approval process sooner than later. Even if you're not planning to buy a home until mid-2025, I would say it's never too early to start the pre-approval process. And that's because if you have a conversation now and there's things that you need to work on, like your credit score or working for a down payment or paying off some stuff in order to put yourself in a better position, you have more time to do it versus starting that process when you're ready and then finding out you need to do this stuff and it's pushing you further and further off into the future. So the earlier you do it, the better off you're going to be. And you don't need to go have your credit score run a bunch of times. You really just need to have it run one time, which shouldn't really affect your score. And you can use that as a foundation to talk to other lenders to shop around rates and do different things when you're ready. Like anything worth having in life, preparation is key. So the sooner you start this process, the better off you're going to be long term. So with that, if you need someone to guide you through that process, my team and I would love to be a part of your journey. You can reach us using that referral link below. But if you found any value in today's video, then do me a favor and hit that subscribe button to stay updated on everything first-time home buyer related.